Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
In this AI-generated podcast, discover how to turn risks into rewards using smart, calculated strategies for both wealth building and business growth. Learn how successful entrepreneurs and investors manage uncertainty, seize opportunities, and thrive under pressure.
Welcome to the Deep Dive. Today we're diving into something absolutely central to business and finance, but something that often gets a bit of a bad rap: risk. But what if we could, flip that? What if risk, when you approach it strategically, is actually this powerful engine for growth, for wealth creation?
Exactly.
Our goal today is really to shift that perspective, to look at how risk isn't just a threat you need to dodge, but just maybe a pathway to some pretty significant opportunities.
That's spot on. The common view, it tends to paint risk as purely negative, doesn't it?
Yeah.
But what our sources are showing, and this is crucial, is that calculated risk that's really understood, managed well, it's often the spark for, truly exceptional results.
Yeah.
We're here to pull out those key strategies for you.
And just to make this real right away, think about this story. Back in 2015, Nigeria's online payment scene, still pretty early days.
Right, very nascent.
But Shola Akinlade and Ezra Olubi, they saw something. They took a big leap, founded Paystack. Fast forward just 5 years.
Only 5 years. They get acquired by Stripe for over $200 million.
Wow. That's phenomenal.
Talk about exponential returns. Right. It's just a fantastic illustration of what we're digging into today: risk in all its forms, and crucially, how you can strategically leverage it. Okay, so let's start unpacking this. When we talk business risks, what are the sort of main buckets we need to think about?
Okay, so the sources lay out 5 key categories. Getting a handle on these is really like step 1. First up, there's market risk.
Okay.
That's about losses from factors hitting the whole market. Think of oil prices swinging wildly. That directly hits energy firms, right?
Yeah, big time.
Then you've got credit risk. That pops up when someone you've lent money to or who owes you doesn't pay up.
Right, defaults and things like that.
Exactly. Third is operational risk. This is about internal stuff going wrong, processes, people, systems failing. A big example, MTN Nigeria, back in 2015, they had that major issue with SIM card registration compliance. Huge operational headache.
I remember that. Yeah, it really showed how internal slip-ups can cause massive problems. Yeah. What's next? Then there's legal and regulatory risk. This is all about changes in laws, regulations, stuff that can really shake up your business. Remember the Central Bank of Nigeria's crypto ban in 2021?
Oh, yeah, definitely. That sent ripples everywhere.
Huge disruption for that whole sector. It's a perfect example.
Okay, so that's 4. What's the last one?
The 5th is reputational risk. And gosh, in today's world, this is huge. A bad customer experience goes viral.
Instantly.
And bam, your company's image takes a massive hit. Remember that United Airlines incident? Passenger dragged off the plane.
Unforgettable, unfortunately.
The video blew up and their stock price actually dipped. That's a direct financial hit from a reputation crisis. So you see, each type needs its own way of thinking about it, managing it.
That makes a lot of sense. So you've got these different flavors of risk.
Yeah.
How do businesses actually figure out their exposure? What tools do they pull out to, size up the risks they're facing?
Right. Assessment is key. There are several really important tools used here. A fundamental one is SWOT analysis.
Strengths, weaknesses, opportunities, threats. Classic.
Exactly. Helps businesses like, say, Flutterwave in the fintech world figure out their internal good and bad points against what's happening outside. Then, especially for companies thinking bigger, like expanding overseas, PESTLE analysis is vital.
PESTLE.
Political, economic.
Social, technological, environmental, and legal. Yeah, it forces a look at that bigger picture, the external forces at play.
Okay, so SWOT is kind of internal plus immediate external. PESTLE is that wider macro view. Got it. What else is in the toolkit?
Scenario planning is another really powerful one. You imagine different possible futures. Think of a giant, Shell Oil. They use this all the time to prep for big global shifts, different energy futures, that kind of thing.
Planning for multiple what-ifs.
Precisely. And then naturally there's financial forecasting. Super important for understanding how things like capital availability or market shifts might impact growth. Well, take the Dangote Group and their huge refinery project.
Massive undertaking. Absolutely. They need really complex financial models to navigate the risks baked in. shifting global oil prices, currency swings.
Yeah.
It's essential, which naturally leads to the next question. Once you've assessed these risks, what do you do about them?
Right. That takes us to mitigation. Yeah. Spotting the risk is one thing, but having a plan, that's where the rubber meets the road. What are some core strategies there?
Well, mitigation is really about two things. Proactive steps, things you do before a risk hits, and reactive measures, how you respond when it hits. A really basic but powerful strategy is diversification.
Don't put all your eggs in one basket.
Pretty much. Look at Aliko Dangote. His business empire grew from sugar and flour into cement, oil, and more. Spreading the risk across different sectors cushions the blow if one area takes a hit.
Makes sense.
Then, obviously, there's insurance. It's fundamental, right? Protects against all sorts of potential losses. And internally, strong internal controls are key things like regular audits, solid compliance processes. They minimize those operational risks we mentioned.
Okay, those feel like the essential foundations. But are there more sort of dynamic approaches?
Oh, definitely. That's where agility comes in. Think about the pandemic.
Yeah, a huge test of agility.
Absolutely. So many Nigerian SMEs, for example, had to pivot super fast. They shifted online, set up deliveries, just to keep revenue flowing when physical shops were shut. That ability to adapt quickly is critical. And it's interesting. There's data backing this up. A 2022 PwC report found that companies with strong risk governance,
The ones taking this stuff seriously.
exactly, they are about 30% more likely to outperform their competitors.
30%. That's a serious edge. Okay, so we've covered understanding risk, assessing it, mitigating it, but we started by saying risk could actually drive success. How does that work? How do businesses actually use risk to get ahead?
This is where it gets really exciting, I think. Taking those calculated risks, it can absolutely create a competitive advantage. Think about first mover advantage.
Like Uber.
Perfect example. Uber took a massive risk, jumping into the ride-hailing market when it was barely a thing. That early move let them build huge brand recognition, grab market share before everyone else piled in.
Right, they define the space.
Then there's innovation. Look at Tesla. Betting big on electric vehicles way back when, that was hugely risky. Market wasn't proven, technology was expensive.
A lot of skepticism back then.
Tons. But that risk-taking positioned them as the dominant player now. And another angle is strategically targeting emerging markets. Companies like Carbon or Kuda Bank here in Nigeria.
The fintechs.
Yeah, they saw huge potential in serving populations that traditional banks may be overlooked. That market has its own risks, for sure, but the growth opportunity was massive. And McKinsey research actually found that companies embracing strategic risk-taking tend to grow around 40% faster.
40% faster. That's
Wow.
So it's really about smart bets, not just blind leaps. Okay, let's pivot slightly. What about us as individuals? How do these ideas apply when we're trying to build personal wealth? What kind of financial risks are we typically up against?
Individuals face their own set of key financial risks. Inflation risk is a huge one, especially somewhere like Nigeria. Inflation hit over 33% in March 2024. That just eats away at the value of your savings.
Makes your money worth less over time, basically.
Exactly. Then there's currency risk. If you deal internationally, or even if you just buy imported goods, big swings in exchange rates, like the Nairo's devaluation, can really hurt.
Imports get way more expensive.
Right. And then, of course, there's plain old market volatility. Stocks go up, stocks go down, bonds fluctuate. It's just the nature of markets.
So, faced with inflation, currency swings, market ups and downs, how do individual investors try to manage that? What are the go-to strategies?
Well, a core strategy, again, is asset diversification. Don't just hold cash or just stocks. Spread your money across different things, stocks, bonds, maybe some real estate, other alternatives. It's the Warren Buffett principle, right? Reduces the hit if one thing tanks.
Setting the risk again.
Exactly. Also, taking a long-term holding strategy. Trying not to panic sell during market dips, but riding out the volatility over years. Here in Nigeria, real estate is also a very popular way to hedge against inflation. Buying property, collecting rental income, it's seen as a tangible asset that holds value.
Provides income too.
Right. Ultimately, it's about matching your investments to how much risk you're comfortable with and what your long-term goals are.
Makes sense. Diversification and thinking long-term seem key. Okay, let's swing back to businesses. We talked about managing risks before they happen, but crises do happen. How do companies build themselves to be, resilient, to weather those storms?
Resilience is so important. It's not just about surviving a crisis. It's about bouncing back quickly, maybe even stronger.
Yeah.
Several things feed into this. The actual business model matters. Think subscription models like Netflix.
Predictable revenue.
Generally more predictable, yeah. even in downturns. The supply chain is another big one. We saw during COVID, companies relying heavily on complex global chains were often hit harder than those who could source more locally. Flexibility there is key.
Less disruption.
Exactly. And having solid crisis plans ready to go. Think about telecom companies like Airtel Africa. They need disaster recovery plans to keep services running, even if there are network outages or other problems. That preparation is vital.
So you're ready when things go sideways.
And you can't discount leadership. Strong leaders, like Tony Elumelu guiding UBA through financial crises in the past, make tough decisions, provide direction. That's critical in turbulent times. And again, there's data. Deloitte found resilient companies tend to recover about 50% faster from shocks.
50% faster recovery. That's huge.
Right.
It really paints resilience as this multi-layered thing of supply chain, plans, leadership. Okay, shifting gears slightly again. Technology. We can't not talk about tech. How's it changing the game for risk management?
Oh, fundamentally, technology is a massive force here. Take cybersecurity. It's non-negotiable now, right? Mm-hmm. Banks like GTB have to invest huge amounts to protect customer data, prevent breaches. The threats are constantly evolving.
It's an arms race, almost.
It kind of is. Then you have AI and predictive analytics. This is being used everywhere. Optimizing inventory so you don't have too much or too little stock, forecasting financials more accurately, even predicting potential equipment failures. It helps you see risks coming sooner.
Using data to look ahead.
Exactly. And then there's blockchain. Still evolving, but the potential to increase transparency and cut down fraud in things like supply chains or financial transactions, it's significant.
Interesting.
The sheer amount of money pouring into this shows how critical it is. Statista reckons global cybersecurity spending will hit something like $260 billion by 2026.
Wow.
And even locally, you see Nigerian startups like Verifime or Identity Pass using tech specifically to help businesses manage identity risks. It's woven into everything now.
It really is remarkable how technology is becoming this core layer for both protection and prediction. But we're human. Our decisions around risk, they aren't always purely logical spreadsheets, are they? What about the psychological side, the behavioral stuff?
You're absolutely right to bring that up. It's huge. Our psychology massively colors how we see risk, how we react to it, often in ways that aren't strictly rational.
Mm-hmm.
We've got cognitive biases.
Like being overconfident.
Overconfidence is a big one.
Yep.
Or herd mentality, just doing what everyone else is doing without really thinking it through. Both can lead to really poor decisions, especially in investing. Then there's the simple fear of loss.
Yeah, loss aversion.
Exactly. It can be so strong it paralyzes people, stops them from taking a chance on a new business idea, even if it looks promising on paper. On the flip side, you have mental fortitude.
The resilience piece again.
Sort of, yeah.
Mm-hmm.
That ability to push through uncertainty, to handle potential failure. Think about the stories of Elon Musk putting basically everything he had from PayPal into SpaceX and Tesla when they were massive long shots.
Huge risks.
Immense. And the work of people like Daniel Kahneman, the behavioral economist, really highlights how important it is to understand these biases, these emotional responses. You need to balance that logical analysis with emotional intelligence.
That's a great point. We're not just calculating machines. Okay, so inevitably, sometimes even with the best plans, the best mindset, things go wrong. Failure happens. How important is learning from that, bouncing back?
It's not just important. Our sources suggest it's almost essential for long-term success. Failure is often part of the journey. The absolute key is how you respond. Doing proper postmortems, really digging into why something failed without blame, just understanding that's crucial for learning.
So you don't make the same mistake twice?
Hopefully. Look at Conga stories. They had early financial struggles, right? But that led to the strategic merger with Zynox. Arguably, that combination made them stronger in the long run.
Turned a failure into a new path.
Exactly. Even reputation hits can be repaired. Axis Bank faced some PR crises in the past, but through consistent community work, CSR initiatives, they worked hard to rebuild trust. And there was a Ford study in 2023 found something like 80% of really successful entrepreneurs had at least one major business failure behind them.
80%. So failure isn't the end. It's often a stepping stone. Okay, one last area. We talked about diversification for individuals, but what about businesses sharing risk with each other? Strategic partnerships.
Yes, absolutely. Collaborating can be a really smart way to manage risk. Think joint ventures, like MTN Nigeria teaming up with banks to push mobile money. They pool resources, share expertise, and share the risk involved in building that new market.
Makes sense. Faster progress, less risk for each party.
Right. Franchising is another model. Someone like Chicken Republic can expand rapidly because the franchisee puts up a lot of the capital and takes on the local operational risk. The parent company shares the brand, the system, but not all the financial burden.
Lower risk expansion.
And then you have really big projects like the Lekki Deep Sea Port. Those often rely on public-private partnerships. Government and private companies share the massive costs, the regulatory hurdles. It allows huge infrastructure projects to happen that might be too risky or expensive for either side alone. It lets smaller players get involved too.
It really opens up possibilities, doesn't it? It's just amazing how many different angles there are to this, understanding our own biases, using tech, building resilience, collaborating. So as we kind of wrap this up, what's the big takeaway, the main message for our listeners?
I think the core message is pretty clear. Risk itself, not the enemy. It's unmanaged risk that's the problem. The real skill, the differentiator for successful entrepreneurs, successful investors, is the ability to see risk clearly, analyze it smartly, and then act decisively, whether that action is mitigating or seizing an opportunity or even sharing the load.
Yeah, couldn't agree more. It boils down to being informed, being proactive, not reactive. We've covered a ton today. Tech's role, diversifying, building resilient businesses.
All crucial pieces. And cultivating that informed, proactive mindset, that's how you really start turning potential challenges into actual pathways for growth, for building wealth.
So here's something to think about as you go about your week. Cast your mind back. Was there a time you consciously stepped away from a risk, avoided it? What potential upside, what reward might have been missed? And knowing what we've talked about today, how might a more strategic, informed approach have possibly changed that outcome? That's your food for thought.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.